In the previous liquidity video, we discussed how important orders were in the market and the concept of liquidity and how it interacts with orders. We discussed how swing points, structural highs and lows, double tops, double bottoms, equal highs, equal lows, and structural liquidity all have orders resting above or below it that the market will gravitate towards to collect orders to then rebalance pricing, and that is the basis for the market to be moving up and down. Now that we understand that and the basic components of liquidity, we can move on to internal versus external range liquidity and its importance in how we can understand order flow, especially when we combine it with market structure and supply and demand. So here we have an example of a bullish bit of market structure. So what we can see, we have higher time frame bullish swing structure. So we've created a swing low and we've created a swing high. And what we know from the market structure videos is that as price is pulling back, we're creating some sort of substructure. Then we get a change of character and we start forming minor structure, and that's what we'd be looking for. So everything that's contained within this range is what's considered a complex pullback. But we can take it a step further in understanding the liquidity that's being built within this swing structure and within this complex range. If we were to zoom in on this higher time frame impulsive leg, this swing structure, and drop down to a lower time frame. So for example, if this was a 4-hour leg of structure and we drop down to the 15-minute to dig into the price action, and what we would see on the 15-minute is much more clear internal range liquidity. And what internal range liquidity ends up being in a bullish swing structure would be equal lows, structural lows, and upward sloping trendline liquidity. And what the basis of these points are for value is there's a collection of orders resting here, there's a collection of orders resting here, and as price puts in its highest high, we know that once price forms a higher high in a bull trend, what do we expect? We expect a higher low to form before we continue to move to the upside, forming a higher high. So when we know that price is likely to form some sort of higher low, then we can look within the swing leg and identify our internal range liquidity, because those points of liquidity are orders that are resting within that swing structure, and the likelihood of price running to those points of liquidity or orders that rest within the internal range liquidity increase, and then we're able to understand how far price action is more than likely willing to push down, in this case, to form a higher low. I've also mentioned in several videos that when we're forming a higher low, we need some sort of catalyst to actually form that higher low, and that's in the form of a demand zone, a sweep of liquidity, or the combination of both. And in this example, what we can see is we have a demand zone right here. We also have equal lows, and what we also have is a collection of equal lows, and a sweep of liquidity that taps into this demand zone, and that's what we see price run off of. Now, a term that gets used quite often in the trading space, it's been mentioned in the Discord as well as on the gram, is the concept of inducement, and a lot of people get confused or tripped up on what inducement specifically is. And what is inducement? Well, quite simply, it is a fancy term for the building of liquidity that is going to be swept for future reasons. So in this case, we're building liquidity here, we're building liquidity here. Why are we building liquidity? Because we have a demand zone that rests just below that. And in order for price to push down, we need more orders, or more willing sellers in this case, to bring price lower so that we can get to a demand zone so that price can then start to move to the upside. So as a result, price needs to start tapping into internal range liquidity, create more liquidity to tap into a demand zone to continue moving to the upside. And what we can see is as we're dropping, we are dropping structural highs that form structural liquidity on the upside. So what we can see is we're still contained within this range of price action. And as price is moving down, taking out internal range liquidity, we're building more internal range liquidity. The difference is we were creating internal range liquidity to the downside in this higher time frame swing structure, and as price was moving down to create its higher low, it was creating internal liquidity for the upside to fuel the move to continue to the upside. Now, if we take it a step further, what we can also just look at very simply is that we have a liquidity void here, we have a liquidity void here, and essentially what's happening is it's filling the liquidity void. All the liquidity void concept is we are filling internal range liquidity to then continue on moving in the direction that price action is intended to move on. And then what we'll often see as well, just to add on to the concept of external range liquidity, is we may actually have a supply zone that's created on the swing structure. We might get an initial small reaction that creates a little bit more internal range liquidity, and then price runs the high. So we've broken this high just barely. It can be by just a pip in many cases. And then what you'll more than likely see is price breaks that structure just by a pip and then takes out the internal range liquidity and taps into another demand zone. Now, this doesn't always happen, but it's something to be mindful of, where we might see swing structure. We might see a lot of internal range liquidity being created, but if we get a reaction point, a failed reaction, and some internal range liquidity, chances are price is going to seek liquidity lower. And what we end up seeing here as well is that we have a liquidity void that price is filling as well. And in this case, we have a demand zone that price reacts off of, and then price continues moving to the upside, creating a higher high. And this is going to be true when demand is in control. What you are going to see is supply failing. And what I've mentioned in several of the videos is that you will see reactions to the majority of supply and demand zones you've mapped out. But the key component or thing that we should be watching out for is not that we've seen a reaction of a supply or demand zone, but what ends up happening next. Is there a follow through or is there not a follow through? So in this example, what we can see is we do react off of the supply zone, but there is no follow through. And as a result, price moves to the upside. We break this swing structure. And if we look at it from the concept of protected and targeted highs and lows, what we can see is this high failed to take out this low. Therefore, this is a strong low, and this would be a targeted high. And as we can see, we've run that high, breaking structure to the upside, which then taps into the external range liquidity. Once we've done that, we do tend to see a reaction point. Price will then pull back, take out any more internal range liquidity that may exist within this leg, and then continue moving to the upside. And at the end of the day, this is the cycle or the price action characteristics that you will find time and time again. Now, you might see different variations of it. You might see different variations of internal range liquidity. You might see a buildup of internal range liquidity that ends up taking up the entire space. What you might see is that price doesn't have a demand zone here. It creates liquidity, it sweeps it. It takes out external range liquidity and then taps into a demand zone. A couple different variations, of course, but this is the basic framework of internal versus external range liquidity in a bullish context. And we can look at it in this exact same way on the flip side for bearish internal versus external range liquidity. As we can see in a bear trend, and as we can see, this would be our 4-hour swing structural leg. We have our swing high and our swing low here. Everything that's moving within this range would be a complex pullback. We'd be looking at substructure being created, and then starting to see minor structure playing out. And then we see a break of the previous swing low or lower low, creating a new lower low. But in this case, we have a break of structure even by a pip. And then what we see is price moves to the upside. So as price is dropping down, again, say this is a 4-hour structural leg and we move down to the 15-minute, what we can start to see is internal range liquidity being created in the form of equal highs, structural high liquidity. And then what we can see is price then starts correcting. We start taking out the liquidity. And as a result, as price is moving to the upside, we're creating more structural liquidity to the downside after all of this liquidity has been swept, tapped into a supply zone, and then price moves. Again, it's possible to get a reaction at a demand zone that's created at the lower low that's created. But the biggest thing that we have to ask ourselves is, do we get a follow through? We don't. In this case, this low fails to take out this high here. Therefore, this would be a weak or targeted low, and as a result we see that break of structure. And again, like I said, in many cases you'll see a break of external range liquidity even by a pip. We take out a little bit more internal range liquidity, tap into a supply zone, and then continue running. Again, there might be more internal range liquidity created in this leg of structure as well, not just this point. And once more, the internal range liquidity could exist in different cases here. Again, we could get a creation of internal range liquidity that taps into this entire space instead of creating more highs as price moves on, or creating equal highs just above the sweep of this bit of liquidity. And then finally, in the event that this ends up not being a supply zone or a valid supply zone, what we could see is a sweep of liquidity, a creation of a supply zone, and then a break of that external range liquidity, and then looking for sells at the newly created supply zone. This concept is incredibly important, and it's incredibly powerful when we combine it with market structure and supply and demand. Understanding where orders are resting in the market and why price gravitates to those areas is incredibly important to understand. So if you still don't fully understand the basics of liquidity, why price is moving to where it's moving, the concept of structural highs and lows, equal highs, equal lows, and structural trendline liquidity, I highly recommend checking out the previous video and then coming back to this video so that everything makes sense. And again, if we look at the bearish example, we have a liquidity void, we have a liquidity void, and we have a liquidity void. And at the end of the day, that's the biggest thing that price is filling. This is the inner workings or the explanation of why liquidity voids are being created in many cases is we are seeing the market taking on all of the internal range liquidity that's being created so that at some point in time, it can then move on to the external range liquidity. The best way of understanding this or conceptualizing it is that price needs internal range liquidity and needs to generate and take internal range liquidity in order to then move on to external range liquidity, whether it's the high or the low, the high or the low. And that's ultimately what's happening when we're seeing price creating higher highs or lower lows. We are taking external range liquidity. And when price is forming higher lows and lower highs, price is then taking internal range liquidity and it's building up the momentum to then take external range liquidity to then continue on the trend if the trend is looking to continue. And when all else fails, always remember the Dorito.